Hey everyone, this is Eve Picker, and if you listen to this podcast series, you're going to learn how to make some change. Thanks so much for joining us on this podcast. I'm Eve Picker, and my life revolves around cities, real estate, crowdfunding, and change. In this podcast series, we'll be digging deep to discover how we can build better cities by building better buildings. I'm excited to have Brian Murray as my guest today. Brian is the co-founder of Shift Capital, an urban real estate group focused on mission-oriented projects in underserved Philadelphia communities. Brian didn't start his career in real estate. He started traditionally at PricewaterhouseCoopers as an auditor and then helped found 2 startups. But the itch to do good was with him, so he joined the Peace Corps and found himself in Bulgaria on the ground doing community development work. The journey into real estate was completed when, once back stateside, he invested in a real estate project in Philly and fell in love with the development process. All of these things come together in Brian, a man focused on doing well by doing good. If you want to know more about Brian after you've listened to this podcast, please visit evepicker.com, where you'll find links and other goodies on the show notes page, and where you can subscribe to my newsletter on all things real estate impact. Well, welcome, Brian, and thank you very much for joining me. I wanted to start by just diving into your background a little. I know you have a company called Shift, and I'm really wondering what led you to this point in your life.
Sure. Well, first off, thanks for having me and Shift on. We're really excited to connect with you and share more. So, I guess background, I started off as an accountant. I graduated college and went to work for PricewaterhouseCoopers, and I left that very, very quickly, knowing that that's definitely not what I wanted to do with my life, and went into the tech world. It was 1999, and 23 was a well-seasoned age to be in the tech world at that time. I had a venture that my first venture went belly up, and I decided that I wanted more out of life, and didn't want to be chasing dollars. So I joined the Peace Corps. I spent a few years in the Peace Corps in Eastern Europe, in Bulgaria, and got introduced to a few kind of core concepts that have really kind of underpinned where I am today. One is that Peace Corps is one of the most incredible organizations at putting people on the ground, in communities, embedded in communities, listening to communities, and really got an understanding of how trust needs to happen on the ground level. I also learned what does economic development planning look like when it actually gets to the ground, and that was a little eye-opening to see the disconnect between a lot of dollars flowing through the nonprofit and international development space, and then what happens actually on the ground. And the third piece, I was introduced to social enterprise. So we launched. I was volunteer with an organization that launched the first social enterprise program in Eastern Europe. And I really fell in love with the idea of doing well and doing good. Came back to the States, went back into the tech world for a few years before heading off to business school to try to marry kind of my love for entrepreneurship and my love for social change and positive social change. I thought I was going to go into the impact investing space. So I went to work for an organization called Acumen Fund, which is a nonprofit venture capital group that invests in businesses serving populations in India, Pakistan, East Africa, And we invested in entrepreneurs that were providing solar powered lights, clean water, healthcare, and was introduced to this growing world of impact investing, which is dollars that want to make a return, but also to do good with that return. Exactly at that time, I'm originally from the Philadelphia area, and when I was in business school, I was approached to invest in a small real estate deal in Philadelphia, which I did as a side project, and we invested in a neighborhood, a lower middle class neighborhood in Philadelphia, and we bought a note from a bank, a 30-unit building that was completely run into the ground by what I'll call a classic slumlord. And I apologize. You want me to restart there?
No. I was going to interject and say, and that was the beginning of the end, right?
I fell in love.
Yes, I knew that was coming.
I fell in love with and really understood the power of real estate in people's lives. So on one hand, I realized what kind of capital usually flows through these neighborhoods, and realized that if I could wake up every day and be a good landlord, I would be doing the world a good service. And so I jumped in 2 feet at that point.
Be sure to go to evepicker.com and sign up for my free educational newsletter about impact real estate investing. You'll be among the first to hear about new projects you can invest in. That's evepicker.com. Thanks so much. I'm not surprised. That's a great story. That's a pretty interesting road that got you there. So, I suppose the next really big question I have is: do you think socially responsible real estate is necessary in today's development landscape? I mean, what have you observed overall now that you are a developer and a landlord?
I would say that 95% of the capital that moves through the underserved communities that we work in is exploitative capital, and exploitative in a economic model that is slightly upside down, that does not incentivize even folks who probably want to do some good in the right ways. And so the importance of capital that is thinking about community, working with community, thinking about different ways in which capital can be layered to make it more effective, I think is critical in an age right now where it feels a little bit like feast or famine, gentrification or poverty, and there's not a lot of discussion of anything in between. And this is a role that I think this type of capital and this type of impact developer needs to really, not only do we need to bring it to the table, but we also need to raise, grow, nurture, support the next generation of real estate developers, and with a particular emphasis on, I think, developers of color, women developers that are coming out of lower income communities, because they are the ones that know their communities best and are best suited to tackle needs and challenges and be aligned with communities.
So, I mean, I'd love to drill down into that. So do you have an example of a good use of capital flowing through those communities, and maybe another example of a bad use? I'm sure you've thought about this, Brian.
Yeah, well, let's talk about the bad first. In the neighborhood we work in Kensington, there was a portfolio of properties that blew up. These are housing, probably about 300 to 400 units that were owned by someone who is literally called the slumlord millionaire. He was taking appraisals, creating fraudulent appraisals, and borrowing money and then not putting it into the housing, and renting them out in their condition.
Wow.
And, this is a larger example, but there's a lot of small examples of this on a daily basis. And in neighborhoods where, in Philadelphia, we have the highest poverty big city in the country. And we have housing where the comparable kind of sales on a 3-bedroom, 1-bath is about $50,000. And when you're that low, it's very difficult to renovate and do the right thing, or to incentivize the kind of capital markets to do the right thing in those neighborhoods.
Yeah.
On the right side, those who are investing the right way and are renovating the right way are starting to see, again, in the neighborhoods we're working in, that people are willing to pay more for a better house. Even though we're talking about lower income neighborhoods, and even though we're talking about maybe 60% of adjusted median income, $100 more for a home in terms of rental allows that landlord to get a lot more done, to add air conditioning, for example, add newer bathrooms and kitchens, and people in these communities do still recognize value and higher quality. And although it's still significantly below 80% of AMI, for example, when you deliver a better product out into even lower income communities, people really respond to that. And we've seen that firsthand on kind of a small level, and we've seen that firsthand in even the commercial world as well. And I think that is, I think that's a market opportunity.
Yeah, I agree with you. 300 units that are being abused in a neighborhood is quite a large block of units and can have a really terrible impact. So I thought maybe you could tell us about a current project you're working on that you're excited about that moves the needle in the right direction. I gather you work solely in this one neighborhood in Philadelphia. Is that true?
So we have a fund that we've invested in 2 neighborhoods in Philadelphia, both along public transportation. So everything we have acquired and are developing are within a 5-minute walk to one of 5 subway stops. We just closed on financing for one project that I'm super excited about. This was a building in the Kensington section of Philadelphia, near the Tioga Station, for those of your listeners who might be familiar. And it's a project called J Central. It's a 140,000 square foot building. It sits right on the main commercial corridor called Kensington Avenue, which has had its challenges with the opioid crisis in particular. And we are creating the first multifamily in the neighborhood. So we'll end up being 130 units with a full first floor of retail on the bottom floor and maker spaces. But what's exciting about this project is that our ambition is for this to be the most civically engaged building in the country. And what that means is we are going to be providing any person who rents from us in this building with a rent rebate if they, for every 4 hours a month that they volunteer in the local community. So we're setting up a whole series of programming and volunteer opportunities within probably about 5 or 6 organizations that are not only locally located, but also driven by kind of local issues and local challenges. And so on the front end, we're definitely filtering folks who are going to come in this neighborhood who want to be a part of such a program. And then this building on a monthly basis should be delivering hundreds of hours of volunteer hours into the neighborhood. What our goal with this, and this is on the residential, the commercial is another piece. So the residential, what's exciting about this is one of the challenges of investing in lower income communities is trying to responsibly create mixed income communities. We do need people who have discretionary income to spend dollars with local businesses so that we can support that type of work. But at the same time, many neighborhoods have had the trouble of having a complete communication disconnect between, let's call it the new and the existing community. And this is a fantastic way, we think, to break down those barriers on both sides, where people coming in now get to know their community better and the community gets to know them better, and hopefully building a level of trust on the residential side. On the commercial, go ahead.
I was going to say that on the residential side, we did an offering on small change in Chicago with a group that they create something called innovation houses. And I think I need to introduce you to Jay, where they give neighborhood volunteers reduced rent in exchange for services in the neighborhood, but they're also really trying to create sort of the next generation of leaders in that neighborhood, which is a pretty remarkable idea. So thinking along the same lines, slightly differently.
I love it. I would be happy to connect with them. The commercial side of this building will also house a Vietnamese coffee group that we've homegrown in our other building, but also the IF Lab. And sounds like this is very similar to what's going to Chicago. This is an incubator and a business services space on a ground floor that is targeted on underserved businesses and specifically trying to put that kind of incubator mentality in, instead of having it in Center City, have it in the neighborhood as well. And the group behind that is an incredible multimedia agency here in Philadelphia that has in the past launched something called the Institute for Hip Hop Entrepreneurship, which was also a incubation style programming, and we're going to try to bring that all into the community as well.
It sounds fabulous. I hope I get to see it when you're finished. It sounds really great. So, of course, this only sort of is the tip of the iceberg, right? So, what would you hope that we trend towards in the next 10 to 20 years? I mean, we've seen gentrification take hold of neighborhoods really rapidly in many cities. San Francisco is having especially difficult issues right now with many people being priced out of housing, and it seems almost too big to solve. I wonder if you have any thoughts about that.
Yeah, we think about it every day. And I'm not sure that we have full answers, but I think we do have a number of kind of ideas behind that. And I believe that, the work that you've done and what's going on nationally with opportunity zones has made these discussions even more important. So, one, going back to kind of what I said before, I think we really need to focus on developing bridges and doors for developers of color and women developers. I think that that's absolutely critical to the future. I believe that we need to bring more powerful tools into communities, financial tools specifically. So we are working here in Philadelphia on creating a neighborhood trust to go alongside our work, where we'll start to also buy up properties that will allow some of this capital to not only stay in the neighborhood, but then be used to help the neighborhood. I believe we need to be more aggressive in cities that are not San Francisco or DC or New York in providing cities and public-private partnerships with more tools to aggressively buy up housing while we can. And those tools, the foundation world has been sitting kind of on the sidelines, and they have endowments and they have lots of capital to bring to this table. And so we're very much pushing for trying to move the needle on trying to bring more financial tools, concessionary capital, other types of capital that can perform differently and act differently than the marketplace.
Yeah, I mean, personally, I also think that there's some governmental work that has to happen. I mean, often gentrification is sort of the last step in numerous things that have happened over decades. And most cities are really not thinking about that, 20 years prior. But just one of the examples I think about often is the way that properties are taxed. I mean, certainly if you're in a neighborhood, if you're aging in a neighborhood and that neighborhood suddenly has much more value and the property values are being reassessed every year or every 2 years, and all of a sudden you have a really hefty bill, that's a problem for someone who wants to stay in place or age in place, who's lived there for a long time. I think there are ways to think about that differently so those people can stay. It's just like one little tool, but I think there are other ways beyond finance that we could think about these problems before they happen. And you're right, maybe more aggressively in cities where it hasn't happened yet. So
this is where the opportunity is, and you're right. The public policy side of it around protecting homeowners, providing homeowners with more micro tools to renovate in place, I think are all part of a more comprehensive strategy that at this point, absent the federal government here, it really needs to happen on local levels, and how we go about, where that leadership comes from. It could come from the private sector. It could come from the community development sector. But it really should, a lot of this needs to be really spearheaded by the government sector, and really, they're the ones that should take that 10,000-foot view and be looking kind of at all pieces of it.
Yeah, I think it's very easy at the end of the day to say gentrification is the developer's fault. But, developers come in all shapes and sizes, like you and me and other ones. And, some developers also have to take opportunities. So by the time, I've seen this happen often, by the time developers step in unthinkingly into a neighborhood that is already transitioning up, it's too late. They're there because it's already worth more. And I just think we've got to step back decades to really understand what's going on. And anyway, that's my personal thought.
No, I just to build on that, one of the things that we're working on and hoping to kind of push out to the world is this idea of, okay, let's talk about the neighborhoods, the adjacent neighborhoods. We're talking a lot about opportunity zones and the opportunities to try to stem the gentrification in those neighborhoods. But to your point, we need to start looking out 10, 20 years in advance. And so some of the tools that we need are for those neighborhoods that the typical developer's not looking at.
Yeah.
I think the other thing that is really important to us is measuring impact, because we all, and we're guilty of it, and the community development group community is guilty of this, and even the hardcore real estate community is guilty of mislabeling what is gentrification. And as a result, we have some communities that, there's a strong NIMBYism going on, and it's a opportunity to educate and think deeply about what change means and who gets to participate. And I think that measuring kind of impact of change in neighborhoods is critical to us to understand what's going right on the economic development front, on the wealth building front, on the inclusion front, and then being honest about what is not going right. We paint a very broad brush when we just, that neighborhood gentrified.
I think that's right. So, I'm thinking of a couple of examples in a neighborhood I know well where after a developer before a developer had built a new house in that neighborhood, the neighboring property was probably worth $20,000. And the woman had lived there for decades and had very little value in that asset. It really wasn't worth putting a new roof on it. But after the house was built on the vacant lot next door, her asset was worth a lot more money. So that added value in the neighborhood did something good for the person who'd been sort of struggling in this neighborhood that was basically disenfranchised. So that's kind of the good side of, I wouldn't even call that neighborhood gentrified, but the good side of increasing values in a neighborhood that we don't talk about.
That's right. We did a study of thinking about the type of equity wealth building that would happen in the neighborhoods we're working in. And there's a home ownership rate of, depending on the block, anywhere between 40 and 50% in these neighborhoods. And to your point, the house that on paper is worth $20,000. Well, if we do this work and the neighborhood becomes safer, and even if we see an increase in a value in a typical row home from 20, 30,000 to 100,000, homeowners in this neighborhood will be building $400 million of equity. Now, I think you pointed this out before. There needs to be real policy interventions when it comes to, well, what does that mean for increase in property taxes and other components that could be problematic? But if we look at what happened, in particular in the African American community, it's been pretty well documented, that the wealth building opportunities that white America had as it fled to the suburbs, and I'm a family that benefited in this way. That was what got me to college, for example, and thinking about how we educate, urban communities about building wealth and what it means and how does it work, and providing the opportunity for them to make the choices that make sense for them, I think is just so critical to this conversation about gentrification. It's
a very complicated conversation, and I think too often it's just painted with one immediate response, which isn't always accurate. So very, very difficult. So, you also talked about community engagement tools that you learned early on when you were in the Peace Corps. And I'm wondering, community engagement's really tough. And I'm wondering how you go about it for your projects and what you think works.
We engage, I guess what we've done and tried to do is to build engagement up and down our entire ecosystem. So we do our own property management. We do our own development. We do some of our own construction. And so we have hired local. We talk about engagement with everyone from the guy we send out to fix the toilet to the guy or woman running our construction teams. And the opportunities for engagement are as simple as being in the street, listening, learning and understanding what are some of the daily problems of the community, in as much as it is in a more traditional real estate way, when we engage the community on, a variance we need when it comes to a project and what that might mean and the input that we need. So, those are just some of, I think, kind of the basic underpinning philosophies of Shift. But beyond that, then we really try to put our, put it all to the test in reality. And so in the last probably 24 months, I can share with you probably 4 or 5 different projects. And I'll just name one or two. One most recent is that we engaged the local charter school to actually, as part of their curriculum, they are doing art projects on plywood that we're using to board up vacant housing in the neighborhood. And they've used it to tell their own stories about the trauma that vacancy has brought into their neighborhood. And it's just been absolutely eye-opening. Wow. We also launched a program called Jumpstart Kensington. Jumpstart Kensington is a real estate accelerator for people in the community. So the argument or the challenge, I think, that I keep kind of going back to is who gets a chance to participate in the upside of a neighborhood. And when a community understands that their neighborhood is changing, do they have the tools, the access to capital, the knowledge to go out and start perhaps buying, renovating, renting, building equity in their own way? So we created a program. It's a real estate accelerator where we provide a series of workshops, mentorship, and now with the help of our nonprofit partner and JP Morgan, we have funding available. And we've brought 65 people through our program to date, of which probably about 90% are a person of color and a woman.
That's pretty fabulous. That's a really great outcome. Have any of them had success with real estate projects in the neighborhood, or are they coming from other neighborhoods, or are they solely from the ones you're working in?
Just like life, it's a total to everything. It's a little bit more complicated to paint a broad stroke, but what I can say is that yes, and yes. So there's some who've come from other neighborhoods. There's some that are just getting some properties up and going now. We're trying to figure out the right cadence to help support them.
Well, that's great. So the other thing you talked about was wealth building in neighborhoods. And I'm wondering if you think that equity crowdfunding can play any sort of role in building communities for everyone.
Absolutely. I think there are real opportunities within almost any neighborhood project. And it could be small, it could be large and meaningful. But I think that But
hold on a second, small can be meaningful, Brian.
Absolutely. I meant, sorry. Thank you for correcting me there.
Don't apologize.
I would say financially meaningful for the project.
Yes, that's correct. Yeah.
But both of them have roles. And I was going to argue that especially the small amounts are educational opportunities. They might not necessarily always be wealth building opportunities for the community, but they're certainly an exciting way in which to bring people into the process, understand what happens behind the scenes in a real estate project, and then, of course, have some pride and ownership over their own community. And whether it's really, truly, again, financially rewarding, or if it's the psychological side of it, I think both of them have an unbelievable power when it comes to the type of work that you're doing, obviously, and we're doing too.
So then the next question is, where do you think the future of real estate sorry, I got to say that again. Where do you think the future of real estate impact investing lies? I mean, I'm asking this because I hear my personal experience is that I hear a lot of people throw out pretty startling statistics, like 85% of people who are have managed portfolios are now looking for some sort of impact or social responsibility in their portfolio. That's a really big number. But I am still to be convinced that impact investors will actually accept a lower return. And that really complicates things in my mind for neighborhoods like the ones you're working in, and actually most opportunity zones where it is really difficult to find, if it's really truly an underserved neighborhood, which was the intent of that legislation. It's very difficult to find a project that can really return to a bigger pocket investor the sorts of returns they typically expect.
I'm deeply I don't want to say troubled, but I think you're right. My experience has been that that even among the quote in quotes impact investing group, there is not yet a strong desire to increase risk at potentially decreasing returns slightly.
Yes.
Yep. I believe that I think that there are a few reasons for that, and part of that's my own experience here is that people who traditionally had people who are real estate investors, and I'm painting a really broad stroke here, but it's not that far off, have typically been real estate investors in the past. Either their family has been, they were in the business, they know the business very well. Impact investors don't know real estate well. They are just starting to dip their toes in on platforms like your own. And it's hard to discern what is risk in real estate and what is risk. There's lots of levels of risk in real estate, as we all know. But
yes.
Now we are adding, an additional risk here, which I'll be frank, having now been doing what we're doing, I think that there's more risk as a real estate investor investing in center city, downtown, high-end rental market than there is in working in lower income communities where demand drivers are just absolutely enormous. And so
I agree with you.
It'll just take some time, I think, for us, and I mean that in this very collective us of, as lots of really great, fantastic groups, doing this work on the ground to continue to educate, to do what you're doing by providing this access to these incredible projects and really continuing to push that education process. And also growing these type of value-driven developers and making sure that we're continuing to prop them up, give them, make sure that the light is getting shined on their work, good and bad. Sometimes it might not always work out, but I think we all have that duty to do that. That's where I think we all need to go as a group.
Yeah, no, I agree with you. So I'm going to end this conversation with 3 sign-off questions that sort of, I suppose, summarize what we've been talking about. And the first one is, what do you believe is the key factor that makes a real estate project impactful?
A project that the community has a real say in, that the community has access to the process, and in the best case scenario, where the community has a benefit from that project as well.
So, and then the second question is, other than just raising money, how do you think involving investors in crowdfunding might benefit impact real estate developers? So, can the crowd do more than just raise money for projects?
That's a fantastic question, and I would turn that back to you. I think I don't have an immediate reaction off that, except for yes, I believe that there are probably ways that investors can play investors, connecting to projects through crowdfunded sourcing can probably crowdsource other resources that could help developers and specifically their projects.
Yeah, one thing I think about just as an engagement tool for someone like you, if you crowdfunded a small portion of a project in your neighborhood, to the people in the neighborhood, now you have a pool of people who are really standing behind you and what you're doing.
That's right. Maybe
that helps at a zoning hearing, or maybe it helps in some other way that we haven't thought about. But I think, that was my idealistic goal in small change, is that, you and I have seen in cities like Pittsburgh and Philadelphia how much people want to be involved in the place they live in. And so it was a way to give them access beyond just talking about it. So I don't know. I'm sure there's more that I haven't thought about, but
I think that's great.
Yeah. And then finally, and this is the really big question, which you probably have thought about, is how do you think real estate development in the United States should be improved?
We need to work with the banks to mandate and improve ways in which real estate financing happens, so that it's not just the usual incumbents that are have access to the type of capital that these projects need. Single-handedly, I think there's a systematic problem of access to financial markets, to the networks that create opportunities to raise equity, and that circle is very small, and it's very difficult for new developers, new entrepreneurs to access, to break in. It's just too high of a barrier of entry.
Yeah, no, I totally agree with you. And that, again, is why I'm doing what I'm doing. So I hope there's a friendly Philadelphia banker out there listening to this who might start some process that helps the developers you're training. In any case, I really enjoyed this conversation, and thank you so much. And I'm sure we're going to talk again soon.
Thank you, Eve. It was great. I love what you're doing. I love what it represents for the industry, and I just want you to keep doing what you're doing.
Okay, thank you. Bye. That was Brian Murray. I hope you enjoyed listening to him as much as I enjoyed talking to him. Brian gave me 3 great takeaways. First, it's possible to have a robust real estate business focused on underserved neighborhoods. Second, community engagement really means embedding yourself and becoming part of that community. And third, finance is at the core of making change. We need financial institutions and the philanthropic world to step up and make it possible to build much more real estate in neighborhoods that need the investment. What did you learn? You can read more about Brian on the show notes page for this podcast at evepicker.com. While you're there, please consider signing up for my newsletter to find out more about how to make money in real estate while making some change. Thank you so much for spending your time with Brian and I today. We'll talk again soon, but for now, this is Eve Picker signing off to go make some change.